everyone, and welcome to the Series A list with Rain Ventures. So excited for you all to join us today for episode 2 of this exciting webcast that will help give you an inside look at the world of venture capital. And so we're going to be introducing you to some of the top early stage venture capitalists in the world. As you know, the world of venture capital has long been shrouded in mystery, and many startup founders are unsure how or if venture capital can be a tool to help them grow their businesses. Today, we're going to be pulling back the curtain on early stage venture capital, introducing you to one of the top investors in the space, and answering the big question, what does it take to get to Series A? So I'm excited to welcome our next guest, partner at Amplifier Ventures and tech innovator, Meghan Breeden. Hey, Meghan, how are you doing?
Hey, Erica, thank you so much for that very warm introduction.
Yeah, so Meghan is a longtime seed stage investor and a graduate of Columbia Business School. And we're going to be talking a little bit about her role at Amplifier and some of the things that she thinks are really important for founders and potentially other investors to think about when they're evaluating a company. So before we get started, I'd love to remind everybody that we're really excited to take your questions at the end. So please be sure to add any questions that you have for Meghan to the Q&A tab. And if you're in the chat, please say hi and let us know where you're tuning in from. So Meghan, tell us a little bit about how you got into venture capital and what motivated this decision.
Sure. So how I got into venture capital was really from the other side of the table. I was in the startup world for many years prior to investing. I actually started out as a publicist for early stage technology companies, such as Skype and Foursquare in their very early days, and helped bring them into the mainstream. And it wasn't until I was working with at the time startup, since exited, company called Stylecaster, that I found that as we were growing the business, whenever there was a question to ask or an obstacle or a win, the investors would always be able to kind of pop in and share their insights, having had this great pattern recognition, basically bringing best practices to the table from looking at their many other investments. And I just found that pattern recognition to be really interesting, and I wanted to obtain that skill set for myself. So I decided to go into investing by way of going back to school, going to business school, because I figured that would give me the ability to, first of all, freshen up my analytical toolkit. Meanwhile, surprise, seed stage investing doesn't really involve that much math. But the there's only one. But the interesting thing about being at Columbia, though, was I'm sure you experienced this too, being there. While I was there, it was really easy to hop on the one train and work part-time at venture capital firms throughout my business school experience. So I made a point of working part-time or interning at a different stage and sector-focused fund every semester, and ultimately came to the conclusion that I didn't know if I wanted to continue operating or investing after business school. So I was able to actually do both. Upon graduating school, I was brought on by a group of sort of board of trustee emeriti from Cornell University to build up what they wanted to become an angel investing network targeted at the Cornell ecosystem. And at this time, Cornell University had just started up Cornell Tech over on Roosevelt Island in partnership with the Technion Institute, while Cornell Medical was spinning out a number of companies. So there was a lot to invest in there. So I basically started up what is called Red Bear Angels from the ground up. And it was effectively my backdoor into venture capital. I built up an angel group of about 100 high net worth individuals and started sourcing and diligencing investments for those individuals, raising capital on a deal by deal basis, which I know you've
a lot of experience with. Yep.
You have a lot of experience with. It's I will say it's a crash course in fund management as well. There are perhaps few things as logistically complex as managing a multi-series LLC angel group like that. So when I was approached by when I effectively reconnected with Trisha Black, who is my business partner now, um, she was starting to think about starting up Amplifyher Ventures. The She came to me with sort of the thinking, well, I have started up an investment vehicle before. A fund vehicle was a really exciting next step for me, and not to mention this amazing focus of supporting women leading high growth businesses. So fast forward several years, Amplify Ventures is a seed stage fund where we invest pre-seeds and seed stage fund, where we invest in exceptional women building high growth businesses across a variety of sectors. And I can get into that a little bit more, but it's been really exciting so far.
That's great. So tell us a little bit about the thesis for Amplify and your experience working in such a kind of targeted market sector.
Sure. So the thesis for Amplify Her, well, I'll say the thesis slash mission since day one has been to basically get more women into the C-suite of high growth businesses. And what we mean by that is there just simply needs to be more decision makers, both at the GP level of venture capital firms, as well as in key decision making roles of the startups themselves, who have just more diverse backgrounds, both gender diversity and diversity all across the board. The impetus behind Amplify is to support women getting into those roles and driving those companies forward. And I mean, I'm sure I don't have to repeat the stats to you, but just for folks who like to on the call who like to hear these stats even more at every day, I mean, it's crazy that only 2% of venture capital dollars go to women every year, right? Go to female founders. And I think it's something around 15% go to gender diverse teams. But what's even crazier to me is that 63% greater results go to their earliest investors when the teams have gender diversity on them. So not to call on my CVS lingo a little bit too much, but that's a value investment if you think about it, right? And not to sound crass about it, but there is an opportunity. And if we are meeting with these women as they're leaving their roles at other high growth businesses to start their own, then we're really accessing this untapped potential and this untapped opportunity that we can take advantage of and elevate the playing field in doing so.
That's great. Well, definitely agree with the thesis. I know we have a lot of men who are listening in today. How can this opportunity to generate alpha potentially help them with their startups and their fundraising activities?
Sure. Well, what I'll say is, I think in any instance, any professional instance that you're in, diversity around the table just enhances outcomes, right? So whether that means stepping outside of your network that's within arm's reach to make your first hires, or really making an effort to diversify your cap table, anything anything you can do to sort of push the boundaries of what your regular networking initiatives are is a way of obtaining that diversity. And that's what we do every day when we're sourcing companies too, right? When we're sourcing companies and when we're helping companies to make key hires, is we're making sure that we're not just picking up our phones and texting the people who are within arm's reach. We're constantly meeting new people. We're constantly bringing people together for our own events and putting ourselves out there in order to make sure that we're meeting everyone. And I think that's really important to diversify networking initiatives in order to change to more of a diverse circle too.
And so, I'd love to get your thoughts on how founders can think about approaching thesis-driven funds in the most efficient way, and how they can look at sort of the landscape of all the different potential VCs and investors out there and figure out where they're going to have sort of the maximum impact for their time and energy.
Well, first of all, I think it's very helpful for founders that more and more funds are are approaching their investment strategy with whether it's a vertical focus or a thesis driven approach, or effectively an infinity approach, right? Because it helps to understand who you're talking to on both sides of the table, as you're entering into these conversations. And there's so much capital out there, and there are so many funds out there, that if anything, it helps to weed down the list to the people who will really have the most impact, so you're not having just a million conversations that aren't necessarily the best fit. So in terms of the vertical funds are perhaps the easiest to understand what thesis is, because for the most part, if you're starting a company in a given space, you're coming across like-minded people in a given vertical, right? If you're starting an auto tech company, auto tech ventures is probably within your network anyway. But if you're targeting a thesis-driven firm that has an evolving thesis in a different category, like a Union Square Ventures or even an Equal Ventures, right? An emerging manager that's very thesis-driven. What's helpful is that there's so much content out there that great investors are putting out all the time, so that you can simply read the blog post and understand, oh, that the company I'm starting is right up this person's alley. I might as well reach out to them, because if anything, it's a great conversation to have. And they're clearly dedicating their time into a space where I'm also dedicating my time. So it helps to make those conversations a bit richer, as well. And as a result, even if it doesn't net out into a transaction, there are other ways that it can be helpful.
Yeah, definitely do your research.
Yeah.
Um, so we know that as investors, we typically, the rule of thumb is we end up investing in somewhere around 1% of the deals that we evaluate.
Mhm.
So knowing that, in any particular meeting, the odds that it's not going to end up in a check are probably 99%. What sort of advice would you give to founders to make sure that even with all those no meetings that they might be taking, they're still getting value out of the experience?
Well, first of all, start with the more of the negative side of that. If it does end up in a no, I would never be shy to ask why. And you might not always get a succinct answer, but a lot of the times you will, and it might not even be an answer that is valuable because it's just one data point. But if anything, it helps you to collect that data and create a pattern from it. And perhaps it's something that in a conversation could be better communicated for next time, for example. Um, I would also, so that's one thing. I'll say two other things too. Every conversation is also can also be customer discovery. So if that's a bit more obvious if it's a B2C company, but even if it's a B2B company, odds are the whoever you're talking to will have some sort of anecdotal connection to the type of customer to whom you're selling, and you can understand perhaps what company that person has looked at in the past, or perhaps what that person's connection might be to that customer, in order to grab more learnings for the product evolution. Um, and then um, and then it's just building network too, because for a lot of time, for a lot of investors, um, a no can simply mean not right now. And it can mean not right now for a number of reasons. It can mean not right now because a lot of pre-seed investors actually are seed stage investors, and pre-seed, seed, and seed plus are all nomenclature at this point, right? So a no can also mean not right now because perhaps a fund is in market fundraising, and then they can put together an SPV to make an investment, but it might take a little bit of time. Or you might come back in 6 months for a bridge round, and that could be a great person to talk to after you get a little bit more traction. So I I would say, just going back, the three things that you can make the most of with any conversation, even if it results in a no, is one data point for how to refine your pitch, and um, customer discovery in some indirect way, and then also just network and relationship building.
Yeah, that's great advice. I mean, I definitely think that folks should really make the most of their interactions with their VCs during a one-on-one pitch, because it's very likely that that person has a lot of kind of subconscious market information around, what other people are doing in your space or in parallel spaces. So to really, take as much feedback as you can
Right.
be helpful. So you said that, you're pre-seed to seed. Tell us a little bit about, what kind of milestones / capital raising activity do you expect a founder to have already completed before you feel that they're at the stage where they can actually take a check from a fund? Because I think a lot of founders kind of have this misconception that they can raise money from a VC fund to build their idea, and that they're going to find a fund that's willing to be first money in. That's not usually the case. So tell us a little bit about what you look for before the company's check ready.
Yeah, believe it or not, a lot of founders can raise money on, a back of the napkin idea, but the the where we will say our point of investment is at proof of product market fit and just about to go to market. And it can definitely depend and it can definitely vary based on the investment, but I'll say that is more often than not where we usually like to come in. It's usually around the point of early proofs of validation, and those are a bit bootstrapped, a bit clever, meaning to say getting an MVP into market and getting early bits and pieces of feedback from prospective customers and really extrapolating those, not only to fine tune and build out the rest of the product, but also to understand where to invest that pre-seed or seed capital in order to most effectively market it. So for example, we are invested in a business that's about to launch, and we were talking about influencer marketing strategy, and they knew through their early, very scrappy validation that YouTube converted much better than did Instagram. And as a result, they're able to save what otherwise would have been like dropping 30K into Instagram influencers to seed their product, because they knew to just focus on what worked and what converted to sales. But that's something that could vary between companies.
Yeah, that's great. So as we talk about, companies actually going through your process and, getting the okay for investment, what would
Mhm.
you say are the three most important things that you're looking for in a startup investment?
Okay, so the three most important things I think are, say, like from a high level, it's market management and product, right? It all ties back to that, and in my opinion, and drilling down, what I mean by that is, first of all, well, I'll start with what's the most important is management, because at the earliest stage, that's really the only given. And the management team is important in the sense that you want to see both drive and passion, which is a bit fluffy to say, I know, but I think beyond that, you want to see the drive that's aligned with the investors. So the drive to generate returns, and the drive to generate returns should inherently sync up to the drive to solve the problem that they're trying to solve. Like, as a founder, you should be able to say, like, I am the only person in the world who can solve this very unique problem that hasn't been addressed yet. And that leads me to market, right? Is the market problem something that is a need to solve versus a nice to solve? Is the market problem something that customers are willing to pay for, in order to solve? And like, is there a willingness to pay for the solution, basically? And that bottom up analysis of who's willing to pay and how many people like-minded are there out there for that initial market opportunity is really important, I think. And then finally, the product is the most likely to change over time, the solution itself. But if the approach to that solution seems to be validated early on, with early proof points, and seems to likely be effective, is pretty much at the stage we're investing the main thing we can solve for.
Okay, great. And so what do you think are the three biggest red flags that you would see in a potential investment that would cause you to put it in the no bucket?
Red flags.
Mm.
Ooh. I would say any kind of drama. Like if there's more time in telling the story that's extraneous to the story, and then definitely a red flag. And more often than not, there is. I don't know if you found this at the early stage, but it could also just be like a factor of storytelling. But
What do you mean? Explain this a little bit better. I'm sure there's a good story behind this. So
yeah, it's like several
give
stories.
us some
Yeah.
clarity.
Um, but you know, if there's too much backstory around the dynamics of the team, or if there's like sometimes there is a recap on a cap table, and there is a story to tell behind the round. And that's not always a bad thing, but sometimes it can be. And then like I guess another red flag too would be if there's too much time in the pitch meeting, an initial pitch meeting, talking about competition. I found that sometimes there's this tendency among founders and to talk about competition up front and say, well, there's this, and this out there. And it's almost as though defining the market problem is talking about the competition. When in reality, um, I always think competition should be a slide that's in the appendix. It should be, there if you need to answer the question, but run with blinders on and look at the market problem and think, for whatever reason, with all of the alternatives out there, because there are alternatives to everything, this market problem has not been solved in the way that I think it should be solved yet. And then a third red flag. I don't know if it's so much a red flag, but like something that think we're going to avoid doing more so now is just I used to be really okay with safe notes, but starting to starting to think that maybe safe notes shouldn't shouldn't be as commonplace as they are.
Okay, well, I'd love to get some detail on the thinking there. Tell us why.
Yeah, sure. So, um, first of all, this isn't usually an issue, but you don't get as much access to information with a safe note. Any random person walking down the street could have just as much access to is allowed to get just as much access to information from a company as you are investing through a safe note. But like if you build a relationship with a team, then you can get that access. So that's not as commonplace of an issue, but it just creates for this kind of messy foundation of the cap table. Like I think it was Ed Zimmerman who once said, I heard him once say, like, it's like you don't want to build a house with a kind of like loosey goosey foundation.
Yeah.
I don't think he used the word loosey goosey, but it's just a way of thinking about it. So it's not a red flag, but I was just thinking of like a third thing that keeping an eye out for now.
Yeah. I mean, I think that's interesting. And I'd love to kind of explore, that area a little bit further, because I do think it's important for founders to be cognizant of, what sort of securities are most appropriate for their rounds. And so I'm guessing you guys are in like, tell us a little bit about your check size and, sort of target size of round for your initial investment. And would that or would that not be something that's more appropriately done as a preferred equity round? Which
Yeah,
I'm guessing you're saying preferred equity over safe note, not convertible note over safe note.
saying preferred equity, I think is the safest bet for how to structure a round. But I'm actually not opposed to convertible notes. We do plenty of convertible notes. And we've even actually written a convertible note into a company that wasn't actively raising, but we had known the founder for a while. I had previously invested through my previous firm, and I just knew that a round would be imminent in the coming months. So we wrote a discount but uncapped convertible note just to give them a little bit more cushion in going into raising that round. So I'm not opposed to that. And I think it's just like a very flexible way of taking in cash while you're moving so quickly as an early stage founder. But to answer your question, so Amplifyher can go up to 250K in terms of check size. We can also write checks as small as 50K into earlier bets. And we don't lead rounds. We join rounds that are that are a number of sizes. I would say the average size round we invest in is like 1 to 2 million. And we very purposefully don't lead rounds because my business partner Trish and I both have marketing and sales backgrounds. So we want to be able to provide value add within those functional areas. And in order to do so, we roll up our sleeves and actually tactically will secure press or edit website copy and do things that kind of take more off the founder's plate. But that also means we need to free up our time to do that so we don't sit on boards and or lead in that way. So that's sort of our approach to how we think about check size and involvement in the companies that we're investing in. So to give you a better picture, we've invested in 30 companies to date since starting the fund a couple of years ago.
Okay, great. Fantastic. So we've talked a little bit about structure, your opinion on securities, and I think that's interesting because, one of the things, that I've definitely experienced during, my time investing is that, one of the benefits of the safe is that it's a little bit more clear exactly what's in there versus with the convertible note, you kind of have no idea what the lawyers have done. So there's, somewhat consistency of, what you're getting.
I know what you
I
mean.
do absolutely agree with you. I think that, as legal costs come down, I'd almost rather, if it's possible, at least in my portfolio, would rather see priced equity being issued for, a round that's kind of 1 to 2 million, just to, really sort of officially get on that cap table and get the security.
Yeah.
One of the, dangers that we've seen with, notes happening that can, be complex is, renegotiation of caps or, discounts or any of that stuff. And at the end of the day, the cap table is always being renegotiated. But those are definitely some tricky things to think about. So moving on, I'd love to sort of take a bigger sort of 30,000 foot view for the founders that are listening and get your perspective on what some of the things a founder should consider when they're just deciding whether or not to raise capital, period. Is venture capital right for them? So what are some of the things that a founder might want to consider?
Okay, I'm so glad you brought that up because I'm sure you get this too coming from the angel world too, is that there are so many types of capital to raise right now. And I think it's so funny that you could open up a newsletter or PitchBook or TechCrunch and think that the barometer of success is raising a venture capital round. And that's the commonplace thing to do. When in reality, venture capital is this high risk, high reward asset class that's really it was only created for a very small portion of businesses. Most businesses are meant to be built as healthy revenue generating businesses that are not on um, this high growth trajectory where you take in a lot of capital a lot of outside capital and are pressured to grow a certain way at a certain pace and then exit, right? So I guess to answer your question, like as an early stage founder, what I would do in terms of thinking of whether or not to raise outside capital is I think of why I would need to take in that capital in the first place. And if it's for the purpose of getting a first line of inventory out the door or getting a product off the ground that will then ultimately be generating revenue, think about all of the different ways to take in debt actually instead. And or other types of structures for raising capital that are that can convert into even dividends or that type of structure. I mean, NDVC came out with that term sheet a few years ago that can be a convertible note that converts into revenue dividends if the company chooses to not continue to raise more money thereafter. So there are a lot of alternatives out there. So I first think about like the impetus for raising capital and how that maps back to what you want the growth trajectory of your company to look like. A lot of times it will be venture capital, right? And then in that case, it's a question of timing. It's a question of when you want to take in that outside capital, when you want to really give up your equity. And in that sense, I think it's really important to keep in mind that um, cash in the near term is actually very expensive, right? Because the equity in your business, in theory, is a lot more valuable than that cash in the near term. So, and you're giving up a lot of it in order to take in that cash. So, which might seem like a very trite thing to say, but it's just important to keep in the back of your mind, right? So the question of timing then comes to how long can you go with bootstrapping and really creatively pulling in all of the resources that you can create for yourself in a very scrappy way in order to generate proof points that make the inherent value of your business high enough where you're not giving up all of your equity. So if you were to go out, if you as a founder were to go out and raise right now on a $3 million valuation, and like, how much could you accomplish in the next 6 months, or is it even feasible in the next 6 months to instead get a couple of like LOIs for pilot partnerships? So let's say if it's a B2B company, and then bump that valuation up to maybe 5 million. And all of a sudden you're maintaining much more equity.
That's great. Yeah, I was going to ask you, what would be a couple tips you might have for companies that, maybe decide that they want to bootstrap a little bit longer. So I
Yeah.
think getting LOIs is a great one. What about for companies that have more of a B2C approach? Any tips on how they can, create more traction before they actually go out and raise money?
Yeah, absolutely. Creating a wait list or a pre-order list. I think it was Away Luggage that had a wait list up for months before actually shipping product. I could be wrong. I can double check, but anything to generate and market that landing page and market that wait list as though that is your product. But better yet, if they're pre-orders, if you have the actual mock-ups of your product to generate meaningful revenue in advance, then all of a sudden you have more cash in the door and you don't even need to raise for that, for every dollar that you're getting in. So marketing your brand as though your brand is a product.
So I love that you brought that up. That's one of my favorite pieces of advice. And if you've never heard this before, Meghan, I can't remember who taught me this, but they call it the Wizard of Oz strategy, right? Which is that you sort of put up this, front like you actually have all these, and then see if people
Yeah.
So, and then you worry about building the back end later. So that's great advice. Great. So, we've talked a little bit about what they should consider deciding whether or not to raise venture capital at all. Let's say that, you have decided venture capital is for you. You're totally cool with a 50% annual cost of capital. So moving on to the next stage, what should a founder consider when deciding which investors to bring on as partners?
Yes, and I think it's really great the way you phrase that question, by the way, because I think people often forget that raising money is a two-way street. And fundraising is a two-way street. It's very much about the types of investors that you want to choose to bring onto your cap table. Bringing every line of your cap table is an opportunity for that investor. So obviously, like, everybody says capital is commodity, right? And it very much is. So investors are differentiated. We talked a bit about the types of investments that different investors set out to make, if they're, let's say, thesis driven or affinity driven. And that is very much reflective of the networks that they can also bring to the table. So I personally, as a founder, if you do have the luxury of making this decision, I would say that think of every investor as an extension of your team, and who you would want to hire, what assets that individual can bring to the table as a key hire. And keep in mind that every investor meeting, for the founder, is just as much a marketing meeting for the investor. When I'm going to meet with founders, I make sure to articulate that, like, what we can bring is helping with marketing and sales, as I mentioned before, and we can really roll up our sleeves and earn our keep on the cap table in doing so. And I'll point to articles and publications and that we secured in Vogue for our fashion portfolio companies in order to say that, it's not all fluff and talk. And I would definitely encourage founders to not so much challenge the investor and put them on the spot like that, but try and get at those real tangible pieces of evidence for the value add that investor brings. Um, and sometimes even back channeling to other founders within the portfolio of that investor can be really helpful. Or even folks who have met with that investor before in the past, even if they don't work together now, might be able to share a few good words here and there.
Yeah, that's great advice. And one thing that I also want, our listeners to be really aware of as they're, developing a relationship with a founder is to, really pay attention, or sorry, with an investor is to pay attention to control issues on the cap table,
Mhm.
particularly when you're, issuing preferred, which I'm sure you're going to be aware of. Your lawyer's going to let you know. But to understand, how much actual control the investor has over investment, over operating decisions that are made in the company, as well as to, be very confident in your relationship around how much they want to support you to continue your leadership position in the company, should it grow quickly or as it grows. Because we've definitely seen some situations where people lose control or they get pushed out. And, I think it's so important to kind of go into that with eyes square wide open and to, feel confident in what you think your long-term relationship with that investor is going to be.
Definitely. And so much of that comes from having transparent meetings up front and articulating what you see as the big vision and the goal for the trajectory of the company. And because it's very much a long game. And ev- every investor is, once they're on your cap table, you are in a partnership for as long as the company and as long as the company exists. So it's definitely important to be aligned in that way. And it's reflected in the term sheets too, right? Like there's a reason why plain vanilla market standard term sheets exist, because they're and they're meant to be aligned, and they're meant to be focused on this pie that's getting bigger, um, as opposed to something that's very up for aggressive negotiation.
Yeah, absolutely. Well, speaking of term sheets, I know that our founders, a lot of new founders and prospective capital raisers tend to be very focused on valuation at the early stage, right? How
Mhm.
important do you think valuation is, and what factors should they consider when they're trying to determine what's an appropriate valuation?
So valuation's a funny thing, because some investors will say, well, it really only matters, like what matters is the the end game. What matters is that this valuation is going to be a lot bigger down the road, and the pie is only going to get bigger. But at the end of the day, too, a lot of investors are out in market fundraising, and they're looking at their multiple over invested capital and their early markups, and they want to be able to demonstrate that steady growth of their portfolio companies. So being able to show that growth means getting marked up in valuation too. So just giving a little bit of a window into an investor's mindset on a day to day. In terms of setting the valuation, what is commonplace is for a founder to say, I'm going to let the market decide, right? And I'm going to let the lead investor set the terms and then negotiate from there. Um, that is that's like, I think, I'm curious to hear your thoughts, Erica. Do like, I think that's a fine default, but I think it's really important to have an anchor in your back pocket. And the way to find that anchor is to look at other companies within a similar vertical that have raised within the past like 3 to 6 months, because valuations trends fluctuate so much. So I would look at talk to other founders within your same vertical and ask them what valuations they raised on, and what type of feedback they got when they were in market. For example, you know, health companies and digital education companies have all of a sudden started receiving these higher valuations than I think they would have a year ago in this
Well, we
post.
all know why that is.
Yeah. And it's so funny because like investors so many investors who are investing in these companies now, I don't think would have looked at a B2B healthcare company a year ago or a digital education company a year ago. But the way consumer behavior is changing is also reflective of these perhaps higher valuations. Some might call them inflated, some might call them justified. So a lot of it depends on what else is in the market within that sort of 6-month cohort of what you're raising.
Yeah. Well, I will give you my perspective on it. And while I do think, the idea of potentially reaching, it would be a little probably hard, I think, for the average person to get information on the terms of a parallel round to a similar company, just because people are pretty close to the vest with that info. That would be a really good way if you could get that, absolutely. There's no harm in asking. But one of the things that I would say is that those data points tend to be, just that, right? Data points. And they could also, not be necessarily structured properly. What I would actually, advise a founder to do, if you are at the stage where you're getting very close to, having a term sheet and setting the valuation, is to see if you can talk to other people who are actually, similar stage VCs who are maybe, not in your round or leading your round, because they will sort of actually have the background understanding to give you a range that's probably appropriate. Because I do notice that, a lot of times when, I do see a founder who's set a valuation that's, dangerously high for them, they're usually basing it on, I don't know, something they read in a newspaper about some crazy company that raised, 25 million in its first round at $100 million valuation. I'm like, well, but was that really a good idea? Was that prudent? So I do think that, you probably could get the information from, similar stage VCs that are maybe in your network who don't necessarily even have to be in the deal, just to ask them, you've sort of looked at my company, like, what do you think would be an appropriate valuation range? And you'll probably get better information.
Yeah, definitely. And by the way, just to clarify, when I meant ask other founders, definitely not founders who are overlapping or competitive anyway, but perhaps like tangential to the vertical. But
Exactly.
yes, other VCs definitely they probably have a few data points that they can share of their own too.
Yeah. And I, I feel like I'm always happy, because, as New York investors, a lot of us kind of have the Wall Street backgrounds and are, really sort of love the sort of pricing aspect of things. So I'm always happy to, educate founders on valuation and the pros and cons of higher versus lower, as well as to give them some sort of market information as to where things are actually trading and why. A lot of the things that happen at the higher end, usually I'd say the number one reason for an early stage valuation getting pushed up is that they're previously successful founders. So people will sometimes compare themselves to, a startup that has, two founders who, previously started like $1 billion company, and they'll think, oh, I should, get that same valuation. So there's a lot that goes into it. Cool. So we're running towards the end of our time. So I'm going to cover just a couple exciting last questions. So one, tell us about the investment that you've been most proud of and what lessons you learned from it.
Oh, okay. Well, I'll talk about an angel investment. So the companies within Amplifier's portfolio, I am obsessed with all of them. I don't want to play favorites. And they're all still growing.
Yeah.
I mean, Hill House Home is a brand that I could talk about for hours. And if you're familiar with Nell Diamond, the CEO, has this incredible vision for the business. And I actually reached out to her on a whim, not even thinking she was fundraising. I just had been following the brand and really respected her very unique and clever ways of marketing it. And she was like kind of sort of thinking about fundraising, but then started thinking about how to grow the business. And fast forward, I won't get into the nitty gritty, but fast forward, we're investors now, and I am so thrilled with how she and her team have been able to take this brand and make it into this attainable luxury lifestyle, and first target at millennial moms and more. And there's one product that they launched within the past year called the Nap Dress. I don't know if you have
Oh
heard.
yeah, I actually read an article on that. I don't know if like you shared the article or I saw it on social, but I've actually heard of the nap dress.
Yeah.
Don't have one, but
Oh, they just came out with more today. Highly recommend checking it. I actually think they already sold out. Anyway, so the way they've marketed this and just the product itself, it's such that it's become viral. Like a literal dress went viral, and I think that that's a demonstration of a very unique team and dedication to the vision behind a brand and a product. I can get into that for hours too. And I guess but again, I don't play favorites. I could talk more about other portfolio companies of ours. A recent investment we made is in a company called Sienna Naturals, which is clean hair care for textured hair, founded by. Did you look at this one? They just closed their secret. I know, or they might be still. Anyway, Hannah Diop is the CEO and founder, and she is this like super dynamic former McKinsey. Very clean formulation obsessed founder, and she has figured out this brand and product that serves an enormous market that didn't have a product like this in it before. And she recently brought on the actress Issa Rae to be her co-founder and business partner. And the brand has just since relaunched last week, so it's a very exciting time for that as well. And I could go through all 30 of them too.
no, it's fine. So we only needed one example, and I love, the Hill House home example is a great one. So I want to now dive into our audience questions. We do have a few. The first is from Janet, who asks, many women don't have friends and family to get funds from. Is it very difficult to get that idea to an MVP? It's very difficult to get the idea to an MVP for women founders. What are your thoughts there on how we can be scrappier?
I could not agree more. And I think the term friends and family financing should not exist. Erica, I feel like we spoke about this on the panel but the concept of friends and family financing should exist. It should just be called angel fundraising because whether you don't have the friends and family to raise the money from, or you're just simply not comfortable raising money from friends and family, which is perfectly reasonable. I think to answer your question though about going from scratch to MVP, I would say some of the bootstrap ways to do it are the MVP can be analog in a lot of instances. If it's a tech-enabled company rather than a tech company, in a lot of instances, the MVP can be something that is put together in a makeshift way. So, for example, you could be providing the value proposition of the company you're looking to build without actually providing the product in order to get that feedback from customers. For example, if you're providing a recommendation engine at scale, you could put together on the back end, it could be simple. It's as simple as a Google spreadsheet with information in it that you're manually using in order to provide recommendations to individuals. And I'm happy
to interrupt you because I would love to provide a real life example of a company that did that that's actually public now. So Stitch Fix, which the founder actually started it at Columbia Business School, started off with an Excel spreadsheet that she just sent around to people, said, answer these few questions and mailing it out. So, that's a great example of, a big, huge tech success that literally, had an idea, but started it with I think Google spreadsheet and email. And that's how they got their MVP off the ground.
I love that story. That's a great example. Yeah. Definitely.
All right, cool. So we have a question from Durand who says, do you only find through debt-based instruments I think he meant fund. Do you only fund through debt-based instruments in your seed rounds? That definitely no. If you do equity funding, what are the key criteria for determining the amount of equity in return for your investment? So I think he's just asking, what are some of your criteria to determine valuation?
Sure, yeah. And like I can clarify too, we don't approach every round that we're investing in as saying we look to have a certain level of ownership. a lot of investors do, but so that's just a different way of portfolio construction from the investor perspective. Um, and then in terms of valuation, so we definitely look at comparables in the market. We look at what it will take to get to the next round, and what this current raise and the current runway can leverage, how the current raise and the current runway can get that company from point A to point B. If hypothetically point B would be a raise of X valuation, and then working backwards from there.
Yeah, absolutely. The working backwards
Yeah.
model. So, I think just to sort of follow up on that, what the way that we sort of think about it, right? And, this is very back of the envelope is, in 5 years, what could this company potentially exit for, right? How much money do they need to raise between now and then, to actually meet that goal, right? How much are we going to get diluted? And then
Mhm.
you pretty much just sort of divide that by 10 or 20, subtract the amount that you're raising, and that's potentially an appropriate free money valuation. So if you're interested in learning more, we have a whole YouTube channel for 1,000 Angels with loads of investor training to sort of dive deep into, how investors actually do valuation calculations and all of these sort of factors that go into it. All right, great. So one last question, and this is from Sudhakar, who asks, we operate a couple of .com websites under a parent corp. If we raise funds for the .com, how would it be? Someone suggested an independent company would be easier. Is that so? So that's a good question. Are investors okay with a lot of different sort of entities and subsidiaries?
So for the most part, we like to keep things simple because they'll only get more complicated. Um, I would definitely have to give the "it depends" answer here, and I'm happy to chat more about that too offline. But I think that if there is some degree to which the subsidiaries are generating revenue for each other, and that then travels upwards to the parent company, then then you could raise on behalf of the parent company. But I think that it definitely depends on how the subsidiaries are interacting with each other, and then also what types of resources they're leveraging from each other.
Yeah. All right, great. Well, I want to thank Meghan so much for her time today. And Meghan, I don't know if you want to throw your contact info in the
Yeah,
chat.
for sure. I'll do that right now.
I know your Twitter is like something a little bit weirdly spelled, but also people should definitely follow you on Twitter, maybe connect with you on LinkedIn, and visit amplifyherventures.com to learn more. And I also want to encourage everyone here to visit Rain VC and 1,000 Angels. If you're interested in investing early stage capital, we'd love to learn more about you. And if you're interested in investing or raising early stage capital, we'd love to learn more about you and see how we can help you get your startup funded or build a great startup portfolio. So thanks so much, Meghan. I appreciate your time today. And thank you, everybody who joined. We will see you in 2 weeks for an exciting interview with Ronaldo, who is the founder of PetPlate and just completed a Series B. So thanks, everybody. Have a great
Thank
day.
you so much, Erica. Thanks, everyone. Thanks, Erica. Bye.
Bye.